Ladies and gentlemen, please fasten your seatbelts. The year 2026 is shaping up to be far more than a simple turn of the calendar for global finance. It is emerging as a decisive year. According to Jim Reid of Deutsche Bank, an extensive agenda lies ahead, one that will have direct and tangible consequences for global markets and individual portfolios alike. Our first focus is on tariffs. The U.S. Supreme Court is expected to deliver a critical ruling on whether presidential tariff authority is constitutional. However, the pivotal moment arrives on November 10th, when the trade truce between the United States and China expires. Will this mark a move toward lasting stability or the beginning of a renewed and disruptive global trade conflict? Markets will be watching closely. Significant change is approaching at the Federal Reserve. Jerome Powell's term concludes in May, raising the question of succession. Will the next chair be Kevin Hassett or Kevin Warsh? By June, a new leader will be in place. Markets are already pricing in approximately 57 basis points of rate cuts. The central issue remains, will the new chair be supportive of market stability or a source of renewed volatility? Fiscal policy is back at the forefront. In the United States, discussions are intensifying around the so-called One Big Beautiful Bill. Yet investors should recall the sharp sell-off in bond markets experienced in 2025. The prevailing sentiment has shifted toward a clear equation. Higher debt implies higher risk. Government's appetite for spending will play a decisive role in shaping the inflation outlook. In November, the United States heads to the polls. A plausible outcome is a divided government, Democrats gaining control of the House while Republicans retain the Senate. Such a scenario would result in political gridlock, significantly limiting the passage of major legislation through 2027. For markets, this uncertainty may become a major source of volatility. Finally, artificial intelligence remains a central theme. The Magnificent Seven stocks continue to dominate market performance. However, investors will recall that in early 2025, a single development related to DeepSeek triggered a 3% one-day decline in the Nasdaq. Should AI-related investments slow or credible signals emerge that the valuation bubble is deflating, years of accumulated gains could evaporate rapidly. In summary, 2026 is not a year for passivity. It is a year for strategic action. Rules are changing, participants are shifting, and the structure of the game itself is being rewritten. The question is not whether volatility will arrive, but whether we will be prepared to navigate it effectively or merely be carried along by the storm.